Before we begin today's analysis, a brief note. If you value clear, disciplined thinking about money and markets, delivered without hype or sensationalism, please take a moment to subscribe to this channel. We don't chase headlines. We don't promise overnight wealth. What we offer is thoughtful financial education for serious individuals who understand that real wealth is built through patience, preparation, and informed decision-making. You'll see the subscribe button just below this video, highlighted in red. A single click helps you stay connected to rational market analysis when you need it most. Now, let's discuss something that demands your immediate attention. The precious metals market is experiencing a moment that few investors witness more than once or twice in their lifetime. Gold prices are pushing toward territory that seemed unthinkable just months ago. Silver is demonstrating the kind of explosive volatility that can either build fortunes or destroy portfolios, depending on how you respond. And the catalyst? War fears. Geopolitical tensions escalating across multiple regions simultaneously. Central banks quietly accumulating physical gold at rates not seen in decades. Currency instability spreading like cracks in a foundation. But here's what most people miss. This isn't really about gold and silver, it's about what these metals represent. A collective loss of confidence in the systems we've trusted for generations. The question you face right now isn't whether precious metals are rising. That's already happening. The question is whether you understand what's driving this movement, how long it might last, and what you should actually do about it. Because windows like this don't stay open forever. Let me be direct with you. I'm not here to tell you that gold is going to make you rich overnight. I'm not going to throw out fantastical price predictions that get you emotionally charged but strategically unprepared. What I am going to do is walk you through exactly what's happening in this market, why it matters, what history teaches us about moments like this, and how to think clearly about your next move, whether you already own precious metals or you're considering your first position. This is about strategy, not speculation, about preparation, not panic. Let's begin. We're living through a period of extraordinary geopolitical instability. Multiple conflict zones are active simultaneously. Trade relationships that seem stable for decades are fracturing. Military buildups are accelerating in regions that have historically been powder kegs. And diplomatic channels that once prevented escalation are proving less effective than they were designed to be. You don't need me to list every hotspot on the globe. You're seeing the headlines. You're feeling the unease. What you might not be seeing is how these geopolitical tensions are directly translating into financial market behavior, specifically in the precious metals sector. When war fears rise, institutional money moves. Central banks reallocate reserves. Sovereign wealth funds adjust their holdings. Large investment firms rebalance portfolios to account for increased uncertainty. And all of that capital flow creates momentum. But here's what's different about this particular moment. We're not just dealing with geopolitical risk in isolation. We're dealing with it against a backdrop of historically high debt levels, questionable monetary policy decisions, inflation concerns that refuse to fully subside, and a global financial system that has been stress-tested in ways that revealed significant vulnerabilities. In other words, the precious metals rally we're seeing isn't happening in a vacuum. It's happening because multiple fundamental drivers are aligning simultaneously, creating a compound effect that magnifies the move. This is why the phrase, "the window is closing," isn't hyperbole. It's a recognition that certain market opportunities exist only when specific conditions converge. And those conditions don't last indefinitely. Think of it this way. When a building is on fire, everyone understands the urgency of the exit. But what about when smoke is filling the room and people are still debating whether there's actually a fire? Those who move decisively during that window, before panic sets in, have options that disappear once the crowd realizes what's happening. That's where we are with precious metals right now. Before we go further, let's establish some foundational understanding. Gold and silver are not typical investments. They don't produce cash flow. They don't pay dividends. They don't grow earnings. If you're looking for them to perform like stocks or real estate, you're approaching them with the wrong framework. Precious metals are monetary metals. They're stores of value. They're insurance policies. They're portfolio hedges against currency debasement, systemic instability, and the erosion of purchasing power. Throughout human history, across every civilization, every empire, every monetary system, gold and silver have retained value when other forms of money have failed. Paper currencies come and go, empires rise and fall, political systems transform. But the core function of precious metals as a store of value persists across all of it. Why? Because you can't print gold. You can't create silver out of thin air with a computer keystroke. These metals exist in finite quantities. They require real labor, real capital, and real resources to extract from the earth. This fundamental scarcity is what gives them their enduring monetary properties. Now, in times of stability and confidence, when economic growth is strong, when currency systems appear sound, when geopolitical risks are low, precious metals tend to underperform other asset classes. They just sit there holding value, while stocks and real estate deliver growth. But in times of instability, uncertainty, and fear, the times we're entering now, precious metals do something that very few other assets can do. They rise in value precisely when you need protection most. This countercyclical behavior is why sophisticated investors maintain precious metals exposure even during bull markets in other assets. It's not about betting that everything will collapse. It's about understanding that when things do become unstable, you want to already be positioned. Silver adds another dimension to this equation. Unlike gold, which is primarily a monetary metal, silver has significant industrial applications. It's used in electronics, solar panels, medical equipment, and countless manufacturing processes. This dual nature, monetary asset and industrial commodity, creates a different risk-reward profile. When industrial demand is strong and monetary demand increases simultaneously, silver can move more aggressively than gold. But it also tends to be more volatile, with sharper corrections and more dramatic price swings. Understanding these fundamental characteristics is essential before we discuss strategy, because if you don't know what you own and why you own it, you'll make emotional decisions when the market tests your conviction. And believe me, this market will test you. Let's talk specifically about war and how it impacts precious metals pricing. War, or even the credible threat of war, introduces a risk premium into financial markets. This isn't speculation. It's observable, measurable behavior that has repeated throughout history. When conflict breaks out or escalates, several things happen simultaneously. First, investors flee from assets tied to the regions directly involved. Stocks in affected countries sell off. Currencies of nations at risk come under pressure. Real estate and business assets in conflict zones lose value rapidly. Second, there's a flight to safety, a rush toward assets that are perceived as less dependent on any single government, currency, or geographic region. Precious metals fit this category perfectly. Third, governments involved in or preparing for conflict dramatically increase spending. Military expenditures surge. Budgets that were already strained get pushed to their limits. And how do governments finance these sudden, massive increases in spending? Often through currency creation, which directly undermines the value of that currency and reinforces the case for hard assets like gold and silver. Fourth, supply chains get disrupted. Mining operations in unstable regions face shutdowns. Transportation routes become unreliable. The physical logistics of moving metals from producers to consumers get more complicated and expensive. All of these factors combine to push precious metals prices higher. But here's what most people miss. The biggest moves often happen before the actual outbreak of conflict. Markets are forward-looking mechanisms. Sophisticated investors don't wait until war is officially declared to position themselves. They move when the probability of conflict rises to levels that change the risk calculus. Right now, we're in that pre-conflict positioning phase across multiple potential flashpoints simultaneously. And that's why you're seeing the kind of price action in metals that historically appears when things are about to get significantly worse. I'm not predicting World War III. I'm not saying that global conflict is inevitable. What I'm saying is that the collective positioning of global capital suggests that very serious people with very large amounts of money are preparing for scenarios that would have seemed paranoid just a few years ago. And when institutional money starts moving for protection, individual investors who ignore those signals often regret it. The geopolitical risk premium we're seeing in precious metals prices right now is real, it's justified, and based on current conditions, it's likely to persist or even expand before it contracts. That's not a guarantee. It's an assessment based on observable factors and historical patterns. Gold has broken through resistance levels that held for months. Trading volumes are elevated. Options activity shows heavy positioning for continued upside. Physical demand, the kind that matters from central banks and large institutional buyers, remains extremely strong. Silver is exhibiting even more dramatic moves. The gold to silver ratio, a key metric that measures relative value between the two metals, has been compressing, which historically signals that silver is playing catch-up after periods of underperformance. Mining stocks, which often leverage the price movements of the underlying metals, have been volatile but generally trending higher. This is important because mining equities can amplify returns when metals are rising, though they also amplify losses when metals correct. The physical market is particularly interesting right now. Premiums on physical coins and bars, the amount you pay above the spot price to actually take possession of metal, have been widening. This indicates that demand for physical metal is outstripping readily available supply. When premiums expand, it's a signal that the paper price and the physical reality are starting to diverge. Delivery times from dealers have been extending. Certain products are experiencing temporary shortages. These aren't signs of a dying market. They're signs of a market under significant buying pressure. Meanwhile, the futures market shows a structure called backwardation in certain contracts, a technical condition where near-term prices exceed longer-term prices, suggesting immediate demand is extremely strong. On the macro level, real interest rates, the difference between nominal rates and inflation, remain in territory that historically supports precious metals prices. Central banks, despite their rhetoric about fighting inflation, are trapped between the need to maintain price stability and the need to avoid triggering financial crises through overly aggressive rate policies. This policy paralysis creates an environment where currency debasement continues, even if the pace slows. And currency debasement is fundamentally bullish for hard assets. The technical picture shows gold breaking out of a multi-year consolidation pattern. Silver is testing resistance levels that, if broken, could lead to rapid acceleration. These aren't guarantees of future movement, but they're the kind of setups that professional traders pay attention to. Most importantly, the sentiment among mainstream investors remains relatively skeptical. While precious metals are getting more attention than they were a year ago, we're nowhere near the euphoric, irrational exuberance that marks the end of bull markets. Most people still think gold and silver are relics, not serious investments. That skepticism is actually bullish. Bull markets don't end when people are skeptical. They end when everyone believes, when leverage is maxed out, and when there's nobody left to buy. We're not there yet, not even close. History doesn't repeat, but it often rhymes. And there are several historical periods that offer valuable lessons for understanding the current precious metals environment. Consider the 1970s. That decade saw gold rise from $35 per ounce in 1971, when the U.S. abandoned the gold standard, to over $800 by 1980. That's more than a 20-fold increase in less than 10 years. Silver went from roughly $1.50 to nearly $50 in the same period. What drove those moves? A combination of factors remarkably similar to what we're seeing today. Geopolitical instability, including the Cold War and regional conflicts, high inflation that eroded purchasing power, loss of confidence in government monetary management, and a general sense that the global order was becoming increasingly fragile. The investors who recognized these conditions early and positioned themselves accordingly built tremendous wealth. Those who dismissed precious metals as irrelevant or who waited until the peak to buy experienced very different outcomes. Or look at the period from 2001 to 2011. Gold rose from around $250 per ounce to over $1,900. Again, this wasn't random. It coincided with the aftermath of the dot-com bubble, the Iraq and Afghanistan wars, the 2008 financial crisis, and unprecedented monetary expansion by central banks globally. Each of these bull markets in precious metals was driven by a loss of confidence. Confidence in the economy, in the currency, in the stability of the system itself. And each bull market had phases. An early phase where only contrarians were buying. A middle phase where the trend became obvious and broader participation increased. And a final phase characterized by euphoria, excessive leverage, and unsustainable price acceleration. Understanding which phase we're in matters enormously for strategy. Based on current positioning, sentiment data, and the broader participation levels, we appear to be somewhere between the early and middle phases. The trend is becoming recognized, but we're not yet seeing the kind of mainstream adoption and media obsession that marks late-stage bull markets. Another historical lesson worth noting: precious metals, bull markets don't move in straight lines. They experience significant corrections along the way. In the 1970s, gold corrected by 30 to 40% multiple times during the broader uptrend. In the 2000s, similar drawdowns occurred. These corrections shake out weak hands, investors who don't understand what they own and panic at the first sign of trouble. If you're going to participate in this market, you need to be prepared for volatility. You need to understand that a 15-20% pullback in an ongoing bull market is normal, not a signal that the trend is over. History also shows that when precious metals bull markets finally end, they often end dramatically. Parabolic blow-offs where prices disconnect from fundamentals, followed by brutal corrections that can retrace 50% or more of the entire move. These endings are characterized by maximum optimism, by ordinary people suddenly becoming gold experts, by leverage reaching extreme levels, and by financial media treating precious metals as the only investment that matters. We are nowhere near that environment today. The historical lesson is this: recognize the phase you're in, prepare for volatility, maintain discipline, and don't overstay your welcome when the warning signs of excess finally appear. Let's discuss the psychological forces at work in precious metals markets, because understanding your own mind is as important as understanding the market itself. Precious metals attract a unique psychology. They appeal to people's fears, their distrust of institutions, their desire for security in an uncertain world. This emotional component can be both a strength and a dangerous vulnerability. The strength is that emotional conviction can help you hold positions during painful corrections that would otherwise shake you out. If you truly understand why you own gold or silver, if it's part of a coherent strategy, not just a trade, you're more likely to weather the inevitable storms. The vulnerability is that fear-driven decision-making often leads to poor timing. Investors who buy precious metals out of panic rather than strategy tend to enter at exactly the wrong moments and exit when they should be holding. There's a common cycle in metals investing that is repeated throughout history. First, a small group of contrarians begin accumulating when prices are low and sentiment is terrible. These are the investors who understand market cycles and have the discipline to act counter to prevailing opinion. Second, fundamentals begin to shift. Geopolitical events, monetary policy changes, inflation dynamics, and prices start to rise. The contrarian accumulation phase transitions into an early bull market. Third, as the trend becomes undeniable, a broader group of investors begin to take notice. This is where most people enter, not at the beginning, but after the move is already well underway. This phase can last for years and can still offer substantial gains, but the risk-reward is less favorable than it was earlier. Fourth, euphoria sets in. Everyone becomes a believer, leverage increases dramatically, price targets become absurdly optimistic. This is the dangerous phase where most wealth is lost because new entrants are buying at exactly the moment they should be preparing to exit. Finally, the crash. When everyone who's going to buy has already bought, there's nobody left to push prices higher. Over-leveraged positions get liquidated, the crowd panics, and prices can fall more quickly than they rose. Where are we in this cycle right now? Based on sentiment indicators, positioning data, and leverage metrics, we appear to be in the transition between the early bull market and broader recognition phases. There's growing awareness, but not euphoria. There's positioning, but not maximum leverage. There's opportunity, but also meaningful risk. Understanding this helps you calibrate your approach. If we were in the contrarian accumulation phase, you'd want to be aggressively building positions. If we were in the euphoria phase, you'd want to be preparing your exit. In the current phase, the appropriate approach is measured, strategic positioning with careful risk management, and a plan for both continued upside and potential corrections. The psychological trap that catches most investors is the need for certainty. They want someone to tell them exactly what's going to happen so they can act without doubt or fear. But markets don't work that way. Certainty doesn't exist. The best you can do is understand probabilities, manage risk, and position yourself to benefit if your thesis plays out while protecting yourself if it doesn't. This requires emotional discipline that most investors simply don't have. You need to be able to sit through a 20% correction without panicking. You need to be able to watch metals surge without getting greedy and over-leveraging. You need to be able to ignore the noise, the daily headlines, the guru predictions, the emotional extremes, and stay focused on your strategic framework. Can you do that? If not, precious metals investing might not be appropriate for you, regardless of how bullish the setup appears. If you already own gold, silver, or mining stocks, you're in a different position than someone just considering entry. Let's discuss strategy for existing holders. First, the most important question, why did you buy in the first place? If you bought precious metals as insurance, as a hedge against systemic instability, then current price increases shouldn't fundamentally change your approach. Insurance doesn't stop being valuable just because the risk you're insuring against hasn't materialized yet. In fact, if anything, rising prices might be telling you that the risks you were concerned about are becoming more widely recognized. If you bought as a strategic investment based on a long-term thesis about currency debasement and geopolitical instability, then you need to assess whether that thesis still holds. Looking at current conditions, ongoing monetary expansion, escalating conflicts, fragile supply chains, political instability, the fundamental case appears to be strengthening, not weakening. This suggests that holding your positions remains appropriate. However, there are tactical considerations. If you've experienced substantial gains, if your precious metals allocation has grown to represent a disproportionate percentage of your total portfolio, you may need to rebalance. This isn't about timing the market or predicting the top. It's about maintaining appropriate risk exposure. A position that was 10% of your portfolio when you initiated it might now be 20% or 25% after significant appreciation. That changes your overall risk profile, potentially leaving you overexposed to a single sector. In this case, trimming positions to restore your original allocation percentage is prudent risk management, not market timing. Another consideration, are you sitting on significant unrealized gains in positions that lack proper tax planning? In some jurisdictions, precious metals are taxed differently than other assets. Understanding the tax implications of selling or holding can impact your net return significantly. This isn't advice to avoid taxes. It's a reminder that tax efficiency should be part of your strategic thinking. For those holding physical metal, consider the security and insurance aspects. As values increase, so does the importance of proper storage. Home safes have limits. Bank safety deposit boxes have their own risks, as we've learned from various banking crises. Professional allocated storage might make sense for substantial holdings, despite the costs involved. If you own mining stocks, the calculus is slightly different. Mining equities are leveraged plays on the underlying metals prices, but they also carry company-specific risks. management quality, production costs, geopolitical exposure of the mines themselves, balance sheet strength. A rising metals price doesn't automatically mean every mining company will succeed. This is where active management matters. You need to periodically reassess the companies you own. Are they well managed? Are their production costs allowing them to maintain margins, even if metals prices correct? Are they over-leveraged and vulnerable to even temporary price weakness? For existing holders, the biggest mistake is complacency. Just because you had the wisdom to position yourself early doesn't mean you can simply ignore your holdings indefinitely. Markets change, conditions evolve. Your personal financial situation shifts. Regular reassessment, at least quarterly, is essential. But equally dangerous is the opposite extreme, constantly tinkering, trying to trade every wiggle in the price, attempting to maximize every dollar of gain. This almost never works. Trading costs and timing errors erode returns. Emotional decision-making takes over. What started as a strategic position becomes a source of stress and underperformance. The balanced approach for existing holders is this: maintain your strategic positions as long as the fundamental thesis remains intact. Rebalance when allocations drift significantly from targets. Take partial profits if you need to reduce overall portfolio risk or if specific holdings have reached levels where risk-reward has shifted unfavorably. But avoid the temptation to outsmart the market with constant trading. Remember, wealth is built through positioning and patience, not through frenetic activity. You've already done the hard part. You're positioned ahead of the broader recognition of this trend. Now the challenge is holding with discipline and managing with intelligence. If you don't currently own precious metals, but you're considering entering the market, your situation requires a different analytical framework. Let's be direct. You're not early. That much is clear. The easy, low-risk accumulation opportunity has passed. Prices have already moved substantially. Does that mean you shouldn't participate? Not necessarily, but it does mean you need to approach this with clear eyes and realistic expectations. The first question you must answer honestly: are you considering this because of genuine strategic conviction, or because prices are rising and you're experiencing fear of missing out? If it's FOMO, if you're reacting emotionally to price action rather than responding strategically to fundamental conditions, then you should pause. Emotional decision-making rarely produces good outcomes. But if you're looking at the same fundamental factors driving this market, geopolitical instability, currency concerns, systemic fragility, and concluding that precious metals should play a role in your portfolio for strategic reasons, then the fact that prices have already moved doesn't invalidate the case for ownership. Here's the framework for thinking about entry as a late-stage participant. Position sizing matters more than timing when you're entering an established trend. Rather than attempting to time a perfect entry, waiting for a pullback that might never come or might not be as large as you expect, consider building a position gradually over time. Dollar cost averaging isn't just for novices. It's a valid strategy for managing the risk of entering at elevated prices. By spreading your purchases over weeks or months, you smooth out your entry price and avoid the psychological trap of putting all your capital to work at what turns out to be a temporary peak. Start with a modest allocation, perhaps 5% of your investment portfolio. This gives you exposure to the trend without creating catastrophic risk if you're wrong about timing. If we do see a meaningful correction, you'll have dry powder to add at better prices. If prices continue higher, you'll still benefit from the move. Physical metal versus paper exposure is a key decision. Physical gold and silver, coins, bars, bullion offer genuine ownership and eliminate counterparty risk. But they require storage, insurance, and accepting wider bid-ask spreads when you buy or sell. They're best suited for investors who view precious metals primarily as insurance or long-term strategic holdings. ETFs and similar vehicles offer liquidity and ease of trading, but introduce counterparty risk. You don't own the actual metal. You own a claim on metal held by a trust or fund. For tactical positions or for investors who prioritize liquidity, these vehicles can be appropriate. But understand what you actually own. Mining stocks offer the highest potential returns in a rising metals market. They can appreciate 2x, 3x, or more relative to the metals themselves, but they also carry the highest risk. They're not for everyone, and they certainly shouldn't be your entire precious metals allocation. If you do choose to include miners, consider this approach: 70% physical or ETFs, 30% carefully selected mining stocks. This balances the stability of owning the metal itself with the leverage potential of the companies that extract it. For potential investors, the biggest danger is overcommitment. Because you're entering after a significant move has already occurred, you're inherently taking more risk than those who positioned earlier. The natural temptation, especially if prices continue rising after you enter, is to become overconfident and increase position sizes beyond what's prudent. Resist this temptation. Set a maximum allocation before you make your first purchase, and stick to it regardless of subsequent price action. This discipline protects you from the emotional extremes that destroy capital. Another consideration: Don't abandon other aspects of your financial strategy to chase precious metals. This move in metals, however significant, doesn't mean stocks or real estate or bonds are suddenly worthless. It means conditions favor precious metals more than they have in recent years. That's not the same as saying metals are the only thing worth owning. Maintain diversification. Maintain an emergency fund. Maintain your long-term investment plan. Precious metals should be a component of that plan, not a replacement for it. Finally, be prepared for immediate regret. There's a reasonable chance that shortly after you establish positions, we'll see a correction. That's just the nature of entering trends that are already in motion. If that happens, it doesn't mean you were wrong. It means you're experiencing the normal volatility of this market. The question is whether you can tolerate that short-term pain for potential long-term gain. If a 15-20% drawback shortly after entry would cause you to panic and sell, then perhaps your position size is too large. Scale it down to a level where volatility won't trigger emotional decision-making. Remember, you're not trying to get rich overnight. You're trying to participate in a major market trend while managing your risk appropriately. If you can maintain that perspective, even late-stage entry can be part of a successful strategy. Let's discuss specific behavioral errors that destroy wealth in precious metals markets, because knowing what not to do is often more valuable than knowing what to do. Mistake number 1, over-leveraging. Precious metals are volatile. Silver especially can move 5 to 10% in a single day. If you're using margin or leverage to amplify your positions, these normal fluctuations can trigger forced liquidations at exactly the wrong time. I've watched investors with correct long-term views get completely wiped out because they couldn't tolerate normal volatility. They were right about the direction, right about the fundamentals, but wrong about position sizing and leverage. And in trading, being right about everything except position sizing still means you lose. Never use margin for physical metals holdings. Never. And if you're using leverage for miners or ETFs, keep it minimal and understand that you could face complete loss of that leveraged position even in an overall bull market. Mistake number 2, emotional trading. Precious metals attract passionate opinions. People develop almost religious convictions about gold and silver. This emotional attachment leads to irrational behavior, refusing to sell even when conditions clearly warrant it, or panic selling during normal corrections, because fear overwhelms strategy. Every trading decision should be based on your predetermined plan, not on your emotional state at the moment. If you're making decisions based on fear or greed, you're gambling, not investing. Mistake number 3, ignoring portfolio context. Some investors become so focused on precious metals that they lose sight of their total financial picture. They let metals allocations grow to 50%, 60%, even 80% of their investable assets. This is dangerous regardless of how bullish you are on metals. Concentration creates catastrophic risk. Even if you're ultimately right about the long-term direction, overlarge positions can force you to liquidate at exactly the wrong time if you need capital for emergencies or other life events. Maintain balance. No single position, no matter how compelling, should dominate your portfolio to the point where its fluctuations dictate your financial security. Mistake number 4, chasing performance. When metals are surging, certain mining stocks or specific silver coins or particular ETFs will be the hottest performers. The temptation to chase these high flyers is powerful, but by the time a specific vehicle has significantly outperformed, much of the easy gains are already captured. You end up buying strength, which often means buying right before correction or consolidation. Focus on solid, liquid core holdings rather than trying to find the single best performer. Mistake number 5, neglecting tax implications. In many jurisdictions, precious metals are taxed as collectibles with higher rates than long-term capital gains on stocks. Others treat them differently. Some transactions trigger immediate tax events, others don't. Trading frequently without understanding the tax consequences can result in a shockingly large portion of your gains going to taxes. This doesn't mean you shouldn't trade. It means you need to understand the after-tax implications of your decisions. Mistake number 6, falling for guru predictions. The precious metals space is filled with personalities making dramatic price predictions. $10,000 gold, silver to $500. These attention-grabbing forecasts generate clicks and followers, but they rarely provide useful strategic guidance. Nobody knows exactly where prices are going or when. Anyone claiming certainty is either delusional or dishonest. Your strategy should be based on fundamental drivers and risk management, not on someone's prediction about specific price targets. Mistake number 7, paralysis through overanalysis. Some investors spend so much time analyzing every possible indicator, reading every opposing viewpoint, considering every scenario, that they never actually make a decision. They're perpetually waiting for more information, more confirmation, the perfect moment. That perfect moment doesn't exist. At some point, you need to make a decision with incomplete information and move forward. Overanalysis is just another form of fear. Mistake number 8, forgetting why you own this. During bull markets, it's easy to forget that precious metals are primarily defensive assets. They're insurance, they're protection, they're hedges. When they're appreciating in price, they feel like growth investments. But if you lose sight of their fundamental purpose, you'll mismanage them. You'll hold too long, hoping for continued gains, when you should be remembering that their real value is protecting you when other things fail. Mistake number 9, ignoring liquidity. Not all gold and silver products are equally liquid. Rare coins, odd weight bars, products from unknown refiners, these can be difficult to sell quickly at fair prices. When you need to liquidate, liquidity matters enormously. Stick to recognized, easily tradable products. American Eagles, Canadian Maple Leafs, major ETFs, established miners. The slight premium you might pay up front is worth it for the assurance that you can exit positions efficiently when needed. Mistake number 10, assuming this time is different. Every bull market eventually ends. Every period of euphoria eventually gives way to reality. The investors who get hurt worst are those who convince themselves that this particular cycle is somehow unique, that metals will keep rising forever, that corrections are impossible, that the normal rules don't apply. This time is never different in the ways that truly matter. Maintain humility. Maintain skepticism about your own convictions. Maintain awareness that markets cycle, and that preparation for the end of a trend should begin long before the end actually arrives. Avoiding these mistakes won't guarantee success, but it will dramatically improve your odds and reduce the likelihood of catastrophic errors that are difficult or impossible to recover from. Beyond avoiding specific mistakes, let's discuss broader risk management principles that should guide your approach to precious metals investing. First principle, position sizing based on portfolio tolerance. Your precious metals allocation should be large enough to matter if you're right, but small enough that you can survive if you're wrong. For most investors, that means somewhere between 5% and 20% of investable assets. If you're particularly risk-averse or have a shorter time horizon, stay toward the lower end. If you're more aggressive and have a longer time frame, the higher end might be appropriate. But exceeding 20% in precious metals crosses from strategic allocation into speculation. Second principle, liquidity reserves. Never put money into precious metals that you might need in the next 12-24 months. These markets can remain irrational or move against you for extended periods. If you're forced to sell during a correction because you need the money for life expenses, you'll crystallize losses that could have been recovered with patience. Maintain adequate emergency funds and near-term liquidity outside of your metals positions. Third principle, rebalancing discipline. Set specific triggers for rebalancing, perhaps when your allocation drifts 5% from your target in either direction. This forces you to take profits when things are going well and add on weakness when sentiment is poor. Rebalancing is counterintuitive. It feels wrong to sell something that's working. But this mechanical approach removes emotion and ensures you're systematically managing risk. Fourth principle, diversification within the metals allocation itself. Don't put everything in gold or everything in silver. Don't put everything in physical or everything in mining stocks. Spread across different forms of exposure to manage the specific risks of each vehicle. A reasonable approach might be 40% physical gold, 30% silver, physical or ETF, 20% precious metals, ETFs, 10% select mining stocks. This provides exposure to the core trend while managing the specific risks of each category. Fifth principle, time horizon clarity. Are you holding for 3 years, 5 years, 10 years? Your time horizon should influence your tolerance for volatility and your response to market fluctuations. If you're planning to hold for 10 years, a 30% correction in year 2 is irrelevant. If you need the money in 3 years, that same correction might require a strategic response. Be clear about your time frame from the beginning. Sixth principle, regular review without constant monitoring. Check your positions quarterly. Assess whether the fundamental thesis still holds. Rebalance if necessary. But avoid the trap of checking prices daily or reacting to every news headline. Constant monitoring leads to overtrading and emotional decision-making. Set a schedule, first week of each quarter, for example, and stick to it. Seventh principle, written strategy. Document your strategy in writing. What are you buying? Why? What's your target allocation? What conditions would lead you to increase positions? What conditions would lead you to exit? When markets become volatile and emotions run high, this written document serves as an anchor. It reminds you of the logical framework you developed when you were thinking clearly. Eighth principle, stress testing. Before committing capital, mentally walk through worst-case scenarios. What if you buy and prices immediately drop 30%? Could you tolerate that? Would you have to sell? Would it impact your financial security? If the worst-case scenario would be catastrophic, your position size is too large, scale it down until the worst case is painful but survivable. Ninth principle, separate speculation from core holdings. If you want to trade or speculate with a small portion of your metals allocation, fine, but clearly separate that capital from your core strategic holdings. Maybe 80% is your strategic position that you hold with discipline, and 20% is your trading capital where you can experiment, take more risk, try to time moves. This separation prevents trading impulses from contaminating your disciplined core positions. 10th principle, understanding that protection has costs. When you buy insurance for your home, you pay premiums every year. If your house never burns down, you don't get that money back. But you don't consider the insurance a waste. Precious metals are similar. In years when the system doesn't fracture, when currencies remain stable, when geopolitics calm down, your metals might underperform. That doesn't mean owning them was a mistake. It means the insurance wasn't needed that year. Don't evaluate precious metals purely on annual performance. Evaluate them on whether they're fulfilling their strategic function in your overall portfolio. These principles create a framework for managing precious metals positions rationally, reducing the impact of emotional decision-making, and improving your likelihood of long-term success. To fully understand the current precious metals environment, we need to zoom out and look at the broader macroeconomic context we're operating within. Global debt levels are at unprecedented highs. Government debt, corporate debt, household debt, all simultaneously elevated beyond anything in economic history. This debt burden creates constraints on policymakers that didn't exist in prior eras. When debt is manageable, central banks can raise interest rates aggressively to fight inflation without triggering systemic crises. But when debt is at current levels, even modest rate increases create severe stress. Government interest payments become unsustainable. Corporate refinancing becomes impossible. Housing markets seize up. This is the trap we're in. Central banks claim they want to maintain price stability and control inflation. But their ability to do so is limited by the debt burden. Push rates too high, and you trigger financial crises. Keep rates too low, and inflation persists. The most likely outcome? A continuing erosion of currency purchasing power over time. Not hyperinflation necessarily, but a steady debasement that maintains just enough economic activity to service the debt without triggering immediate collapse. This environment is structurally bullish for hard assets like precious metals. Then there's the geopolitical dimension. We are witnessing a fracturing of the post-World War II global order. The US dollar's role as the unquestioned global reserve currency is being challenged, not eliminated, but challenged, by various countries seeking alternatives. Central banks worldwide, particularly those outside the traditional Western alliance, have been accumulating gold at rates not seen in decades. They're not doing this randomly. They're doing it because they recognize the strategic importance of holding assets that aren't dependent on any single nation's currency or political stability. When central banks are net buyers of gold on this scale, it provides a fundamental floor under prices that's difficult to break. Energy markets add another layer. Geopolitical tensions often disrupt energy supplies. Energy prices impact everything: transportation costs, manufacturing costs, inflation rates, consumer spending power. Precious metals have historically shown positive correlation with energy prices during periods of supply disruption. If current geopolitical tensions escalate into actual supply shocks, energy prices will spike, inflation will accelerate, and precious metals will benefit from both the inflation hedge component and the safe haven demand. The de-dollarization trend is gradual but persistent. Countries are conducting more trade in currencies other than dollars. China is promoting the yuan for international transactions. Russia is cut off from dollar-based systems. Other nations are creating bilateral currency agreements that bypass the dollar. This doesn't mean the dollar will collapse tomorrow, but it does mean the absolute dominance of the dollar is eroding at the margins. And as that process continues, it reinforces the case for holding assets that aren't tied to any single currency system. Technology is also playing a role. The rise of digital currencies, blockchain technology, and alternative payment systems is changing how people think about money itself. While cryptocurrencies attract the speculative attention, precious metals benefit from the broader questioning of traditional monetary systems. When people start asking what actually gives money value, they often arrive at answers that favor tangible, scarce assets with thousands of years of monetary history. Looking at market cycles more broadly, we're in a period where multiple long-term trends are converging. We're in the late stages of a debt supercycle that began in the 1980s. We're in the early stages of a major geopolitical realignment. We're in a transition period for global monetary architecture. We're experiencing the consequences of over a decade of unprecedented monetary expansion. When multiple major cycles align, the resulting market moves can be both dramatic and prolonged. The precious metals bull market of the 1970s lasted nearly a decade. The 2000s bull market lasted approximately 11 years. If we're indeed at the beginning of a similar cyclical move driven by comparable fundamental forces, we could be looking at a multi-year trend, not a brief surge. But cycles don't last forever. At some point, and it's impossible to know exactly when, the conditions driving precious metals higher will shift. Perhaps governments will successfully reduce debt burdens. Perhaps geopolitical tensions will ease. Perhaps monetary policy will find a stable equilibrium that restores confidence in currency systems. When those shifts occur, precious metals will likely peak and enter a new bear market. That's years away based on current conditions, but it's important to maintain awareness that bull markets end and to remain alert for the signs that conditions are changing. For now, the macro picture supports continued strength in precious metals. But for now is a critical qualifier. Stay informed, stay humble, and stay ready to adjust when the macro environment shifts. We've covered a great deal in this discussion. Let me bring it all together with some final thoughts. The precious metals market is experiencing a significant move driven by real, substantial factors. Geopolitical instability, monetary policy challenges, currency concerns, and systemic fragility. This isn't media hype or baseless speculation. It's observable reality reflected in price action and positioning. The window of opportunity we're discussing, the chance to position in precious metals before broader recognition drives prices significantly higher, is real but narrowing. Not because metals are about to collapse, but because every day that passes brings more investors into awareness of these trends. If you already own precious metals, your primary focus should be on disciplined holding and intelligent risk management. Don't let short-term volatility shake you out of positions established for sound strategic reasons. But also don't become complacent or allow allocations to drift into dangerous territory. If you're considering entering the market, recognize that you're not early. That doesn't disqualify you from participating, but it does require careful position sizing, gradual entry, and realistic expectations. You're not going to get the full move from bottom to top. Accept that reality and focus on capturing a reasonable portion of what remains. For both groups, the critical factor determining success or failure will be emotional discipline. Can you sit through a 25% correction without panicking? Can you resist the temptation to leverage up when things are going your way? Can you ignore the daily noise and stay focused on fundamental drivers? Can you maintain balance in your overall portfolio rather than becoming obsessively concentrated in one area? Your answers to these questions matter far more than your market timing or position selection. Remember what precious metals actually are. They're insurance against scenarios you hope won't occur but need to prepare for anyway. They're strategic hedges against currency debasement and systemic instability. They're stores of value that have preserved wealth across thousands of years of human history. They are not lottery tickets. They are not get-rich-quick schemes. They are not substitutes for a comprehensive financial strategy. If you approach them with appropriate humility, rational position sizing, and long-term perspective, they can serve an important function in your wealth preservation and potentially in your wealth building. If you approach them with greed, over-leveraging, and emotional decision-making, they will likely cause you significant financial pain. The choice of approach is yours. The current market environment appears favorable for continued precious metal strength. War fears are real. Monetary challenges are substantial. Geopolitical instability is escalating. These aren't going away tomorrow. But maintain perspective. Markets cycle. Conditions change. What's working today won't work forever. Your job isn't to predict the future with certainty. It's to position yourself reasonably for the most likely scenarios while protecting yourself if you're wrong. Do that with discipline, and you'll navigate this environment successfully regardless of where prices go next month or next quarter. One final thought. The most successful investors aren't those who make the most dramatic predictions or take the most aggressive positions. They're the ones who survive long enough to benefit from being roughly right about major trends over time. Survival requires risk management. It requires humility. It requires accepting that you'll never capture the full move, that you'll sometimes be temporarily wrong, and that preservation of capital matters more than maximization of gains. If you can internalize those principles, if you can trade the excitement of potential massive gains for the steadiness of disciplined strategy, you'll be in the small minority of investors who actually build lasting wealth from major market trends. The precious metals opportunity in front of us is significant. The risks are real but manageable. The path forward requires thought, discipline, and courage. You have the information you need to make intelligent decisions. Now it's up to you to execute with the maturity and discipline that separates successful investors from the crowd. Thank you for your time and attention. Stay disciplined, stay rational, and remember that wealth is built through preparation and patience, not through panic or speculation.